You know, most people think investing is about finding the next big opportunity, the next explosive stock, the next moment where everything suddenly changes. But Benjamin Graham believed something radically different. He believed that investing was not about excitement at all. It was about survival, and that belief came from a life shaped not by comfort, but by loss, discipline, and deep thinking about human behavior. To understand Graham's philosophy, you first have to understand the world that shaped him, because his ideas were not created in a classroom. They were forged in crisis. Benjamin Graham was born in 1894, long before stock charts were digital, long before financial news traveled at the speed of light. He grew up in a world where money was tangible, where fortunes could vanish overnight, and where mistakes were not theoretical, they were permanent. When Graham was still young, his father died, and his family's financial security collapsed. That early exposure to uncertainty planted a seed that never left him. From that moment on, Graham was not interested in getting rich quickly. He was interested in never being helpless again. As a young man, Graham was brilliant, exceptionally so. He graduated from Columbia University at the top of his class and was offered prestigious academic positions. But instead of choosing comfort, he chose Wall Street. Not because he loved risk, but because he wanted to understand it. And what he discovered there shocked him. Markets, he realized, were not rational machines. They were emotional crowds. Prices moved not because of value, but because of fear, greed, hope, and panic. And most people, he observed, were not investing. They were gambling while pretending to be intelligent. This realization became the foundation of everything Graham would later teach. He saw that people didn't lose money because they lacked information. They lost money because they lacked discipline. They confused price with value. They reacted emotionally instead of thinking logically. And worst of all, they trusted the crowd at precisely the moments when the crowd was most dangerous. Graham didn't want to beat the market by being faster or smarter. He wanted to survive it by being calmer. Then came the Great Depression, the ultimate test. Stocks collapsed. Fortunes evaporated. Entire lives were destroyed financially. Graham himself suffered massive losses. At one point, his investment partnership was down nearly 70%. Many would have given up. Many did. But Graham didn't abandon his principles. Instead, he refined them. He realized that investing could never be about prediction. The future was too uncertain. Instead, investing had to be about protection. That's where his most famous idea was born, the margin of safety. Graham argued that you should never invest based on optimism alone. You should only invest when the price you pay is far below the value you receive. That gap, that cushion, is what protects you when reality doesn't behave as expected. Because reality never behaves as expected. Most people think safety comes from certainty. Graham understood that certainty doesn't exist. Safety comes from humility, from admitting that you can be wrong and building your decisions so that being wrong doesn't destroy you. This idea alone has saved more money than any clever strategy ever invented. Graham also introduced a character that perfectly captured his view of the market. He called him Mr. Market. Mr. Market, Graham explained, is your emotional business partner. Every day he shows up and offers to buy or sell assets at different prices. Some days he's euphoric, other days he's depressed. But here's the key insight. You are not obligated to listen to him. You can choose when to act and when to ignore him. Most people do the opposite. They let Mr. Market dictate their emotions. When prices rise, they feel smart. When prices fall, they panic. Graham taught that intelligent investors do not follow Mr. Market's mood. They exploit it. They buy when prices are irrationally low and sell when prices are irrationally high. Not because they are brave, but because they are disciplined. Discipline for Graham was everything. He believed that intelligence without discipline was dangerous. He saw brilliant people lose fortunes because they couldn't control themselves. They chased trends. They overestimated their ability to predict. They believed that this time was different. Graham had little patience for that phrase. History, he believed, does not repeat exactly, but human behavior always rhymes. One of Graham's most important contributions was the distinction between investing and speculation. Investing, he said, is an operation that promises safety of principal and a satisfactory return. Anything else is speculation. This definition sounds simple, but it is devastatingly strict. By this standard, most people who believe they are investors are actually speculators. Speculation is driven by hope. Investing is driven by analysis. Speculators ask, what will the price do next? Investors ask, what is this worth? Speculators focus on excitement. Investors focus on downside risk. Graham believed that if you take care of the downside, the upside will take care of itself. This mindset made Graham deeply skeptical of forecasts. He did not believe in predicting interest rates, economic cycles, or market tops, not because they weren't interesting, but because they weren't necessary. The future was unknowable, but value could be measured. And measurement, unlike prediction, could be done rationally. Graham taught that stocks are not lottery tickets. They are ownership stakes in real businesses. That sounds obvious, but most people forget it the moment prices start moving. Graham never did. He analyzed balance sheets. He studied earnings stability. He looked for businesses selling below the value of their net assets. These were not glamorous investments. They were often boring, neglected, and unpopular, but they were safe. Safety, again, was the theme. Graham understood that wealth is built not by brilliance, but by endurance. If you avoid catastrophic losses, time becomes your ally. Compound interest does the rest. But if you chase excitement and suffer large drawdowns, compounding works against you. Losses require disproportionately larger gains just to break even. Graham called this the tyranny of mathematics. Another critical insight Graham emphasized was emotional control. He believed that the biggest enemy of the investor lives inside their own mind. Fear causes people to sell at the worst possible time. Greed causes them to buy at the worst possible price. The market doesn't exploit people. People exploit themselves. To counter this, Graham recommended rules, not because rules guarantee success, but because they prevent self-destruction. He advocated for diversification, not to maximize returns, but to minimize regret. He understood that no single investment is worth betting your future on. Diversification is humility in practice. Graham also warned against overconfidence. He saw that success often makes investors reckless. After a few wins, they begin to believe they are special. They increase risk. They abandon discipline. And eventually the market humbles them. Graham believed that the market is a powerful teacher, but a cruel one. It teaches through loss. Perhaps Graham's greatest legacy was not his own fortune, but his students. The most famous of them was Warren Buffett. Buffett didn't just study Graham's techniques. He absorbed his philosophy. Buffett once said that Graham's book, The Intelligent Investor, changed his life. And if you study Buffett's career, you can see Graham's fingerprints everywhere. The patience, the discipline, the focus on value over price, the refusal to speculate. But here's the twist most people miss. Graham himself evolved. Early in his career, he focused heavily on statistical bargains, companies trading below liquidation value. Later, he recognized that quality matters too. He acknowledged that paying a fair price for a wonderful business could be superior to paying a wonderful price for a mediocre one. This intellectual flexibility is often overlooked, but it's crucial. Graham was not dogmatic. He was rational. That flexibility is one of the most human aspects of Graham's thinking. He did not cling to ideas for ego. He updated his beliefs when evidence changed. In a world where people defend opinions like identities, Graham's willingness to adapt is a lesson in itself. Graham also believed deeply in independence of thought. He warned that the crowd is usually wrong at extremes. When everyone is optimistic, risk is highest. When everyone is pessimistic, opportunity is greatest. This requires courage, but not reckless courage. It requires quiet confidence grounded in analysis. For modern investors, Graham's lessons are more relevant than ever. Technology has changed markets, but it has not changed human psychology. Fear still spreads faster than facts. Greed still disguises itself as intelligence. Noise has increased, but signal remains rare. Today's markets move faster, but the principles remain slow and steady. Margin of safety still protects. Emotional discipline still matters. Understanding value still beats predicting price. Graham's ideas are not outdated. They are timeless precisely because they are grounded in human nature. Graham never promised riches. He promised survival. And survival over long periods leads to prosperity. This is a message many don't want to hear. It's not exciting. It doesn't sell dreams, but it works. In his later years, Graham reflected on his career with humility. He didn't see himself as a genius. He saw himself as someone who avoided big mistakes. That, he believed, was enough. And perhaps that is the most powerful lesson of all. You don't need to be extraordinary to succeed financially. You need to be rational. You need to be patient. You need to protect yourself from your own impulses. You need to remember that investing is not a test of intelligence, but a test of character. Benjamin Graham died in 1976, but his ideas are still quietly at work in portfolios around the world. They are not flashy. They do not trend, but they endure. And in a financial world obsessed with speed, endurance is the ultimate advantage. So if there is one message to carry forward, it is this. Investing is not about being right. It is about not being ruined. Build margin of safety into your decisions. Treat volatility as information, not instruction. Think independently. Control your emotions. Respect uncertainty. And above all, remember that the goal is not excitement, but freedom. Because money, when handled wisely, is not about luxury. It is about dignity. It is about choice. It is about never being forced into decisions out of fear. That was the lesson Benjamin Graham learned early in life, and it is the lesson he spent decades trying to teach the world. And if you truly understand that, you're already ahead of most people. Not because you know more, but because you think better.